Hi, I am Jorge. I'm running The Officials, a new publication covering the physicals and derivatives markets. You want to know about what is really happening? Read it. You want to hear about the real stuff? Come and watch. I am The Official. Welcome, ladies and gentlemen, to the third edition of The Officials podcast. We're going to tell you what is happening and varnish. Please watch our podcast and hit the like button if you can. So, to my left here, I have William, Harry, and Dr. Wu. Welcome to our edition. For the viewer, we have various very important things happening. As you know from our previous edition, we were very bearish on the market. And we were foreseeing that within 3 weeks, the market was most likely going to hit 75 or 78. I think I was a 78 guy. So I'm going to use my ranking to say, well, I was right. And it hit it not in 3 weeks, but in a matter of 4 or 5 days. But the reason we were mostly bearish last time was because the global macros are very terrible, and they continue to be. And they weighted down the market very heavily. And we hit some serious lows of 78 plus. And then we had a jump because of the attack on the Hamas leader in Tehran. But I wanted to pass it to Will. How do you see all that movement? I mean, it was very sharp down, then up.
Yeah, it was almost like a reversal, wasn't it? I think the macro picture really did weigh on flat price for a number of weeks before as we moved into the back end of last month. And GDP in China is very disappointing at the moment. It's about 3% last time I checked. In the US, it's slightly better. It was printed at 2.8% annualized, which was better than markets expected, but still no crazy growth there. And there's been a little bit of a turn in labour markets as well. So unemployment, initial jobless claims are ticking up. Tomorrow's NFP data should be interesting to look at that. But the headline unemployment figures do still remain at about 4% in the US, 4.1, which has given the Fed a little bit more room. And we've seen a little bit of a change in the Fed's perspective, and they're kind of moving towards considering both arms of their dual mandate a little bit more, looking at maximizing employment as well as inflation. So that's interesting that they're noting that turn in the economy.
Yeah, one of the things I'm observing, and perhaps it's because I'm looking at the prices so closely and listening to my colleagues here as economic experts, is the market is not just moving because the market is short or long, but it's reacting very quickly and strongly to macroeconomic data. What are your thoughts, Harry? You are perhaps the eminence in this group.
No, thank you, Jorge, for that cardinal observation. But I agree with Will. I mean, the string of economic data, as we highlighted in the last podcast, is just really not bright. It's actually, as you mentioned, it's sometimes terrible. So we got the latest PMI data out of China as well that we could add to the long list of disappointing economic data. And from a sentiment perspective, I mean, the market is turning short. The positioning as we observe it is turning short, especially on Brent. And so you had this downward pressure up until obviously the latest geopolitical events. So first the attack on the Golan Heights that allowed for the first leg up, followed by obviously reporting by the New York Times that Iran would engage in direct retaliatory attacks on Israel. So the question then becomes, how much of this geopolitical premium that has been inflated, if you will, into their oil price is going to remain. And I think that's a key consideration. The macro backdrop is bearish, and we even tested below that $80 psychological support, went to 78, recapture the 80 handle, but really thanks to geopolitics. So how long is the risk premium going to last? And we've been here before. We've had drone attacks on Israel. Israel responded in kind. And as long as the responses are within what is called a proportionate response, then the market is not going to think any further of it. And then it becomes an opportunity selling into these burgeoning risk premia in that downward trend that we're seeing.
So what you're saying, if I may crunch it, is the market hit 78. It has jumped a little bit over 80. And this is a sell opportunity kind of.
Yeah. In essence, if we're looking as to why it recovered the 80 handle, it was a result of a succession of geopolitical events. So, of course, Golan Heights, retribution by Iran directly on Israel. So that's what's really propped up the price. Otherwise, we were in a downward trend. Last week, you were betting on 78. I think Will, I, and Vincent, we were more on the 75 camp, so a little bit more bearish. But again, if there is an attack, a kinetic motion by Iran on Israel, and the response is what is called proportionate, then we're going to fade the geopolitical risk premium like we have done in the past, and this becomes a sell opportunity. At the end of the day, if the market remains convinced that there is no risk to either oil infrastructure, production, or transport, then this changes nothing to the oil balance. And we're back to our broader trend that has been driving markets.
Okay, I'm now going to go to Dr. Wu, because you tend to look, I have noticed, more at the technicals in the market, the signals coming in from the traders positioning really. Would you concur that 80, 82 is a sell, or what are those signals telling us?
I do believe that 80 to 82 has been sort of an equilibrium level for the oil market participants so far this year. 80 is a crucial psychological level of support, and Brent crude did test below the 80s briefly, 78, but it is worth noting that prices seemingly found a floor a few hours before these attacks were announced. So we could say that perhaps this is at 78 it was a level to buy, but also for existing shorts to take profits. At 80 to 82, I would think it's neither a buy nor a sell, but it is worth noting that the market sentiment seems to change on a daily basis, whereas on Monday and Tuesday it was more on the macroeconomics. Yesterday and today is more on geopolitical risk. What's the main story for next week? We're yet to find out.
Yeah, I talk, of course, to many people in the market, and there are some that are incredibly bullish. And one of them was telling me this time is different because the attack was in Tehran, and this would elicit a non-proportionate response. Our point of view, and we have written about it, is I don't think the next big war is coming in our way. I think people are far more mature than we give them credit for, and the fundamentals will again start asserting themselves. We saw the Bank of England cutting rates today by a quarter, and our expectations perhaps on the Feds is that they're going to essentially release a 0.25 next month. Is that enough to, again, re-energize the economy, Harry, or how do you feel about that? Or do we need a bigger cut?
Well, I think in the very short term, from an asset pricing perspective, it's going to be received positively, although there is a certain now concurrence of thinking that September is a go. Yesterday's press conference post FOMC by Jerome Powell, he came as close as he could possibly come to saying that there was a green light for a cut. Now, obviously, we still have a couple of inflation prints, and the Fed being, vocally data dependent when it comes to its decision making, if these inflation prints were to surprise to the upside, then we have that outlier risk that September may not be the month where the Fed moves. But in any event, as said yesterday, Chair Powell pretty much green-lighted a cut in September. That's fairly well baked in. I think when it's announced, you'll get a bit of a pop. We're going to likely see yields come off, bonds rally. How long will it last remains to be seen. The U.S., I guess, exceptionalism, so to speak, is that it has a rebalancing labor market. It's weakening, but it's not in a bad state. And if they continue in this fashion, then they are going to possibly engineer that elusive soft landing that everyone likes to achieve when you're a central banker. Do we need more rate cuts at this point? Probably not. I think the U.S. is going to do a step-by-step, easy as she goes approach, because again, the pricing of various assets is relatively buoyant. And what's going to be interesting in that context is we have a number of earnings reports being released for tech and other big companies. So the stock market already is holding up, if not rising, despite the recent correction. It's back on an upward trend. No, honestly, at this point, it's easy as she goes. They're not going to rush into it. If it's delayed, the response could be asymmetric. That's where it's bad.
Because one is to get accustomed to surprises, and we had the Venezuelan elections with Mr. Maduro again getting reelected. I think the total vote count was over 100%, which made us chuckle a little bit. And Mr. Maduro, I think, is owning up to his name. In case you don't know, that means ripe, but maybe that means overripe, actually. I'm going to give here a little bit of a plug on the edition of Tuesdays of The Officials. We published the data of the Venezuelan exports, and we were surprised to see that the U.S. gets as much oil as China does from Venezuela. So please look at the edition of Tuesdays. This past Tuesday, the data is there. We also thank Kepler for providing us with the core data for that. And also note that India obtained the exception to also import Venezuelan crude oil. And another source was telling me yesterday that Asia is going to be awash as OPEC will increase production in the fourth quarter. May. I think it will. It's leaking out already. And so we'll have Venezuelan crude coming in, more American crude coming in. And this is reflected in the low prices for Dubai relative to Brent. Dubai has really underperformed, and will tell us where the Dubai is now relative to the premiums as it gets sold. If you can add a little bit into that.
Yeah. So we saw last month the Dubai premium it shot up, the physical premium. We were kind of well over $1 average for the month, but then it started to come off. So now we've drifted under $1. We at the close today it was 98 cents. So it's starting to ease off a little bit.
And this will result in the Saudis in the next couple of days issuing the OSPs. As I survey the market in Asia, they tell me, a range between 30 cents and 70 cents. I think they're going to come in about 55 cents to the upside versus the previous month's premiums. They could even come at 50 or 45, but I think the number that we should expect is an increase along those lines. And really, to more or less close this session, I would like to hand it over to Harry on the big sleepy time I got out of the OPEC meeting today with the GMCC.
Well, yeah, the Joint Ministerial Monitoring Committee came and went without any real surprise in terms of communication around current supply policy. Current supply policy for the OPEC Plus group remains a return of barrels scheduled for Q4, again, subject to market conditions. I think this was something we were talking about a little bit earlier today. I think it's well worth noting this one article, Article 6, in the press release of the last OPEC ministerial meeting. Because I was rereading it this morning and I was like, wait a minute, what is this article? And it grants permission to the Joint Ministerial Monitoring Committee to call upon a ministerial meeting whenever conditions in the market warrant it. So the OPEC ministerial meetings that decide supply policy now happen twice a year. The next one's in December. However, OPEC has this optionality through the monthly ministerial meetings that the JMMC can call a ministerial meeting if required. So I would not be surprised if over the course of the next months, if market conditions were to deteriorate or the balances look looser, that if OPEC had to hold a ministerial meeting, it doesn't have to wait until December. The JMMC could recommend a meeting. There's no time frame in this Article 6 of the press release for the last OPEC meeting. So effectively, they could call a ministerial meeting. They don't have to be present in Vienna at headquarters. They've held meetings virtually before. And so it's, from my point of view, it's an interesting optionality that they have. I personally think, like you think they may leak barrels back into the market. My view is that they're still smart enough when they count their barrels to see that it's going to be very difficult for the market to absorb that extra volume. And if they do, either take the market share and accept the lower oil price, or try to hold up the oil price and remain where you are.
Well, in other words, and to summarize it, it is summer, it is hot. Maybe we feel sleepy, but OPEC at the moment makes me feel really sleepy in what they're doing. And maybe they will wake me up in December, but not this month.
Vincent, what do you think? OPEC reaction. Anything this summer? Like Jorge seems to suggest that there's not going to be much happening. Something more for the fall, or you may see them react a little bit earlier.
I think probably two sides to OPEC. Their heart says yes, their mind says no.
Well, I want to hear what you have to say tomorrow in your Woo Fridays podcast, which you have promised to us to be a hell of a cracker with a lot of market information. So, okay, I'm looking forward to seeing that. Thank you very much, everybody.